When did you last think about where money actually comes from? Not how you earn it, not how you spend it. But where does it originate in the first place? Most people carry a quiet assumption through their entire lives. That money is finite. That somewhere, locked behind thick walls and heavy doors, there is a fixed supply. A vault. A limit. A number that does not change. It feels logical. It feels safe. But that assumption is wrong. Money is not discovered. It is not stored in some finite reserve waiting to be distributed. It is created, continuously, by design. Right now, as you watch this, new money is entering existence somewhere in the global financial system. And once you understand how, and more importantly, why, everything you thought you knew about value, savings, and wealth begins to look completely different. Think about what you have witnessed just in your lifetime. Every few years, a government somewhere announces a massive stimulus package. Every decade, a financial crisis erupts, and almost immediately, new money floods the system in response. Global debt does not plateau. It climbs. The money supply does not stabilize. It expands. And yet, through all of it, asset prices keep rising. Homes become less affordable. Stock markets reach new highs. Real estate compounds quietly upward, year after year, decade after decade. Most people notice these things separately, like unrelated headlines. But what if they are not separate at all? What if every single one of these patterns is connected? What if this is not a coincidence? What if this is not a system failing? What if this is the system working exactly as it was designed to work? Before we go further, let us slow down and build some foundation. Central banks are not shadowy, untouchable institutions. Think of them as the engines powering modern economies. They control one of the most important levers in finance, interest rates. Simply put, interest rates are the cost of borrowing money. When an economy begins to slow, central banks lower those rates. Borrowing becomes cheaper. Businesses take out loans. People spend more. Growth returns. This process is called economic stimulus, and on paper, it makes complete sense. It sounds measured. It sounds responsible. And honestly, on the surface, it genuinely is. Governments are responding to slowdowns, protecting jobs, and keeping economies moving forward. Most people hear this and nod along. But here is what most people do not realize. The consequences running quietly underneath that surface tell a very different story. But here is what that surface explanation quietly leaves out. Modern economies are not built on savings or productivity alone. They are built on debt. Governments borrow. Corporations borrow. Individuals borrow. And all of this borrowing creates an obligation, not just to repay the original amount, but to repay it with interest. That interest is the part most people never stop to think about. Because that interest requires more money to exist than was originally created in the first place. Think about that for a moment. If every dollar in circulation was borrowed into existence, where does the extra money come from to pay the interest? More must be created. More money must always exist tomorrow than exists today. Not because of greed, not because of mismanagement, because of mathematics. It is written into the structure itself. This is where the logic becomes unavoidable. Without continuous money creation, the existing debt simply cannot be serviced. Think about what that means in practice. Loans would begin defaulting. Businesses dependent on credit would collapse. Governments carrying decades of accumulated obligations would be unable to meet their most basic commitments. The entire structure would begin contracting under the weight of debt that can never be fully repaid. So the system does not create new money because those in power are reckless or irresponsible. It creates new money because stopping would trigger a collapse far worse than anything most people have witnessed in their lifetimes. This is the part that changes how you see everything. Printing money is not a choice made from ambition. It is a requirement built into the foundation. Stopping is not a policy option. It is an existential threat to the entire architecture of modern finance. Now, let us map the full cycle clearly. Debt creates the need for growth. Growth requires central bank intervention. Intervention creates new money. New money enters the financial system as liquidity. Liquidity inflates asset prices. Inflated assets dilute the value of existing currency. And then the cycle begins again. This is not chaos. This is the rhythm of modern finance. Central banks have specific tools to keep this rhythm going. Quantitative easing is one of them, where central banks purchase government bonds, injecting money directly into financial markets. Then there is interest rate manipulation, lowering the cost of borrowing to stimulate spending. And during moments of financial stress, liquidity injections flood the system to prevent collapse. Each tool serves the same purpose. Not to fix the cycle, but to keep it moving. Always forward. Always expanding. But the real story is deeper than cycles and mechanisms. When central banks create money during a crisis, it does not spread evenly across the economy like rain over open ground. It moves in a specific direction. It flows into financial markets first. Stocks rise. Real estate rises. Bond prices rise. The people who already hold these assets watch their net worth climb. Not because they worked more. Not because they produced more. Simply because they were already positioned inside the system. But the person earning a salary, saving carefully in a bank account, experiences something entirely different. Their savings do not rise with the tide. Their purchasing power quietly shrinks. Pause on that for a moment. The same event. The same money creation. Two completely different outcomes. Not by accident, but entirely by design, depending on where you stand inside the system. Now here is where it gets uncomfortable. Inflation is not always accidental. When a government carries enormous amounts of debt, inflation becomes quietly useful. A debt of $1 trillion becomes significantly easier to repay when the currency it is denominated in is worth considerably less than before. The numbers stay the same. The burden shrinks. Think about that for a moment. The system needs your money to lose value so that it can survive. This is not a conspiracy theory. There are no shadowy figures in a room making secret decisions. This is a structural feature, built into the very foundation of how modern economies function. And most people never see it because it does not happen overnight. It happens gradually, invisibly, across years and decades. Think about your own life for a moment. Groceries that cost noticeably more than they did 5 years ago. Rent that keeps climbing while wages struggle to keep pace. A savings account that technically earns interest, but somehow buys less every single year. The dream of owning a home seems to move further away, no matter how disciplined you are. This is not about personal failure. It is not about spending too much or saving too little. These are the lived consequences of a system that requires currency dilution simply to keep functioning. Every time new money enters circulation, the value of the money already in your hands quietly decreases. Ordinary people absorb that cost. Not investors, not institutions, everyday people. And the most striking part is this. Most of them were never taught the mechanism behind it. And this is not a story about one country making poor decisions. Step back further, and the same pattern appears everywhere. The United States, the European Union, Japan, China, the United Kingdom. Every major economy operates within the same framework. The same debt cycles are repeating across decades. The same central bank interventions are arriving on schedule. The same asset inflation is lifting prices beyond ordinary reach. The same quiet erosion of purchasing power is affecting ordinary people in every corner of the world. This is not a coincidence of geography or politics. It is a shared architecture. And here is the part that changes how you see everything. This is not an emergency measure being used too often. This is maintenance. Routine, deliberate, ongoing maintenance. The system does not print money to recover from a collapse. It prints money simply to continue existing at all. Most people are taught to think of money printing as a response, something governments reach for when things go wrong. A crisis tool. An emergency lever is pulled in moments of desperation. But the evidence tells a different story. Look at the data across any major economy over the last century. The money supply has expanded in good times and bad, during periods of strong growth and during periods of total collapse, during wars, recoveries, booms, and recessions. The expansion never stopped. It only changed pace. So here is the reframe. Money creation is not the exception. It is the operating condition. It is the background process running at all times, quietly, continuously, whether the news covers it or not. Not a tool taken off the shelf during emergencies. The shelf itself. The permanent architecture beneath everything you see. And that is where we leave you. Not with fear, not with outrage, just with clarity. The money in your pocket is not a fixed store of value sitting still, waiting to serve you faithfully. It is a unit inside a system specifically engineered to expand, continuously, quietly. Whether you are watching or not. You were never taught this in school. It was never explained on the news. But the pattern was always there, hiding inside headlines about stimulus packages, interest rate decisions, and rising asset prices. Now you see it differently. Not because the system is evil, but because you finally understand what it actually is. The question was never where you earn money or how you spend it. The question was always where it comes from. Now you know. This is Behind the Spends, decoding the systems behind spending.